Have you ever thought about how the global financial system might end? Forget the Hollywood scenes of stock tickers spinning out of control and panicked traders shouting on Wall Street. The real collapse, the one that's unfolding right now, is much quieter. It's a slow, grinding process, happening in a place most people aren't watching. Japan. This isn't just another financial story. This is about the silent unraveling of the world's economic order. And it all comes down to one country that has quietly become the linchpin of global debt. For decades, Japan has been the silent pillar holding up the entire structure. Think about it. Japan is the world's most indebted major economy, with a government debt-to-GDP ratio that would make any other country tremble. But they didn't just accumulate debt. They became the world's largest foreign creditor and the biggest overseas owner of U.S. government bonds. They are the architects of the zero-interest rate world we've all been living in. For years, the Bank of Japan has been on a mission: suppress risk, keep borrowing costs at zero, and print endless money to buy up government bonds and even stocks. This created a strange kind of stability, an illusion that a country could borrow indefinitely without any consequences. This Japanese model became the blueprint for central banks everywhere after the 2008 financial crisis. The US Federal Reserve, the European Central Bank, they all followed Japan's lead. Keep rates low, print money, and hope for the best. And for a while, it worked. Asset prices soared from stocks to real estate. The world got hooked on cheap debt, and Japan was the primary dealer. They exported their deflation and their zero-rate policy, creating a global environment where risk seemed to have vanished. But this was all built on a fragile foundation, and now we're seeing the first major cracks appear. The problem is that you can't defy economic gravity forever, and right now the Bank of Japan is losing control of its most important market, its own government bonds. The whole system was built on the central bank's ability to dictate interest rates. They would simply announce a target, say 0.25%, and promise to buy an unlimited number of bonds to keep the yield from rising above that level. For years, the market believed them. Traders knew it was pointless to bet against a central bank with infinite printing power. But something has changed. Inflation, a ghost that Japan thought it had banished, has returned. Not just in Japan, but globally. As prices rise, investors are no longer willing to hold a 10-year bond that pays almost nothing. They are starting to sell. They are challenging the Bank of Japan, daring them to make good on their promise to buy everything. This is a game of chicken, and the market is calling the central bank's bluff. For the first time in a very long time, the Japanese bond market is refusing to obey. Yields are pushing past the central bank's targets, forcing them to print even more yen to buy up the bonds. Just to give you an idea of the scale, in a single month recently, the Bank of Japan spent more buying bonds than the U.S. Federal Reserve did at the peak of its quantitative easing program, in an economy a fraction of the size. This is not a sign of control, it's a sign of desperation. They are trying to plug a massive leak in a dam with their finger, but the pressure is becoming immense. Why does this matter to you, sitting in your home, possibly thousands of miles from Tokyo? Because Japan's bond market isn't just about Japan. It's the anchor for global interest rates. The yield on a Japanese government bond has long been the risk-free rate against which all other assets are measured. When that anchor breaks loose, everything is set adrift. Think of it like this. For years, global finance has operated on a simple formula: borrow money for free or close to it in yen, the famous yen carry trade, and then invest that money in higher yielding assets around the world, like US stocks, Australian real estate, or Brazilian bonds. This flow of cheap money from Japan has inflated asset bubbles everywhere. It has propped up markets and made everyone feel richer. But what happens when the cost of borrowing in yen starts to rise? The entire trade reverses. Hedge funds and big financial institutions have to unwind these positions. They have to sell their US stocks, their European bonds, their emerging market assets, all to pay back the yen loans that are suddenly becoming more expensive. This isn't a trickle. It's a potential tsunami of selling pressure that could hit every market simultaneously. We are already seeing the warning signs. The Japanese yen has been falling dramatically against the dollar. This is a direct consequence of the Bank of Japan printing trillions of yen to defend its bond yields. A weaker yen might sound good for Japanese exporters, but it's a disaster for the Japanese people, as the cost of imported energy and food skyrockets. More importantly, it's a signal to the world that the central bank is trapped. They can either defend their bond market or defend their currency. They can't do both. If they let bond yields rise to reflect reality, the Japanese government would face an immediate solvency crisis. The interest payments on their massive debt pile would explode, consuming a huge chunk of their national budget. It would also bankrupt banks and insurance companies that are loaded up with these low-yielding bonds. This is the path to a classic disorderly default. So they choose the other option: print money to hold yields down. But this devalues the yen, imports inflation, and erodes the wealth of its citizens. This is the quiet collapse. It's not a single day of panic. It's a slow, painful process of currency debasement. It's the frog being boiled slowly. The wealth of an entire nation, and by extension, the stability of the global system, is being sacrificed to maintain the illusion of control over the bond market. The quiet, orderly facade of Japan's financial system is breaking. The market is starting to realize that the debt is not consequence-free. The risk that was suppressed for so long is now returning with a vengeance. And because the entire global financial system adopted Japan's playbook, the fallout will not be contained within its borders. When the world's largest creditor nation starts to wobble, it sends shockwaves everywhere. Remember, Japan owns over $1 trillion of U.S. Treasury bonds. What happens if they need to start selling those bonds to raise cash or defend their own currency? U.S. interest rates would soar, making it more expensive for the American government, businesses, and consumers to borrow. Your mortgage rates, your car loans, your credit card interest, all of it is connected to this quiet drama playing out in Tokyo. This is the endgame of a multi-decade experiment in monetary policy. We were told that central banks could manage the economy, that they could print money without consequence, and that debt didn't matter. Japan was the poster child for this theory. Now it's becoming the cautionary tale. The collapse isn't a sudden event. It's the slow, irreversible failure of a policy that has run its course. What we are witnessing is not just a market correction. It is a fundamental shift in the global financial order. The era of consequence-free debt, anchored by Japan's zero-rate policy, is over. The silent pillar is crumbling, and we are all standing in the building it was meant to support. The collapse isn't loud and explosive. It's a quiet surrender to the economic laws that were ignored for far too long.